is for us to understand what are tangible assets, sometimes they're called plant assets, and the three methods of depreciation. When we talk about assets, there are items that companies have, belongs to the company, but technically they are future economic benefits. They bring future economic benefits. Assets can be classified as current assets or non-current assets, depending on how soon they bring cash into the company. Some assets can bring cash into the company within a year or within a given operating cycle. Then they are classified as current assets. Then the other assets take more than a year to bring in cash into the company, or more than one operating cycle to bring in cash into the company. They are called non-current assets. So the classification of current assets and non-current assets is based either using a reporting year or the operating cycle. Generally, it is the reporting year. When we talk about assets, one type of asset is tangible assets. And in tangible assets, we can group these tangible assets into various classes. The classes represent assets of similar items. Examples are motor vehicles, land, buildings, machinery. So under the motor vehicle class, the assets being grouped there could be of motor vehicles of different makes and brands. When asset is being bought, there's a purchase price. There are also other expenditures that are required to bring this asset to the intended use. So bringing it to its use. So the asset value is not just the purchase price, but also other costs that are incurred to bring this asset into use. So the purchase price could be 200, and all other expenditures could be the purchase price could be 2,000, all other expenditures could be 200, and the asset value that is recorded is 2,200. It is 2,200. Most assets lose value, except for land. Land does not lose value. All other assets lose value over time. So there's a decline in asset value. Asset is acquired, then it is used, and finally it is disposed or discarded with no value. So that reduction in value is called depreciation. The estimated reduction in value is called depreciation. So for us to determine depreciation, there are three amounts that we require. One is the cost. When I say cost, it is the cost of the asset bringing it to use, because that is the asset value. Then the salvage value or the residual value. That is the final disposal value. Sometimes there's no disposal value. It is zero. And then the useful life. So the value that is depreciated or value that is reduced is from cost to the salvage value. Let's say 2,200 is our cost. If the salvage value is zero, then 2200 minus 0 equals 2200. So that is the depreciable amount. That is the value that will be lost over time. Sometimes there could be salvage value 100, let's say 2200 cost minus salvage value 100, that is 2100. That is the depreciable value. So it is the depreciable value that will be lost over time. So there are three methods of measuring or estimating depreciation to determine depreciation. The first one is called straight line. Under the straight line method, company estimates that the asset will lose value in equal amount in each time period. Under the reducing balance method, asset begins to lose value, more value initially, and progressively decreases. It is again an estimate that has been made by the company of the reduction in value. The third one is asset value is decreased or depreciated based on the units that the asset produce. Because you take the total number of units the asset can produce, and based on the actual number of units produced in a given period, it measures how much the asset has lost value. Let's take an example. Here's straight line method. Asset value decreases in equal amounts over the period. So here's an example. Asset value is 2200, residual value or the salvage value is 200, and the depreciable amount is 2000. Useful life is 4 years. Every year that asset will decrease by 500. This is called the straight line method, equal amounts. Under the reducing balance method, asset value decreases more in initial years and progressively less in later years. The reducing balance method calculates the depreciation based on the balance at the beginning of that period. Here's the beginning balance of the asset, 2200. And we calculate the percentage of decrease in value using a formula for reducing balance method, and we apply that formula to that initial balance here, and that is the depreciation expense. And the ending balance of the asset or the revised balance of the asset is the beginning balance minus the depreciation for that period is the beginning balance. And that beginning balance becomes the basis for us to determine the depreciation in the next year. So 1210 into 45% is 545 in the next year. And then the ending balance is 1210 minus 545, 666. So that 666 becomes the beginning balance to determine depreciation in that year. So you can see that depreciation expense is more in the initial years and then it decreases over the years. The units of production method is where we look at the number of units that the asset was used to produce, and the total capacity of that asset to produce units. Now in this instance, asset has the capacity to produce 1000 units, and then in the first year it produced 200, second year 300, fourth year 400, and fifth year and fourth year, first year 200, second year 300, third year 400, fourth year 100. So 200 divided by 1000 becomes the percentage for that year. 300 divided 1000 becomes the percentage for that year. And we apply that percentage to the depreciable amount of the asset. Depreciable amount, not the asset cost, depreciable amount of the asset. You can look at here. Under the straight line method, we also applied for the depreciable amount, but over the 4 years as a constant amount. But here in the units of production, we apply to the depreciable amount, but the percentage here is not constant. It is different because it is based on the actual amounts.